Welcome to vTalkInsight, Market Drivers Daily for June 9th, 2026. Today, the AI funding wave, easing but fragile energy risks, and a more hawkish rate path are colliding. And that mix is starting to reprice where growth, liquidity, and volatility can sit across assets. AI remains the dominant growth story today. And after last week's shakeout, risk appetite around the theme has snapped back. AI-exposed benchmarks like the semiconductor index have rebounded strongly. Futures point to more upside, and leverage markets such as Korea have rallied hard, highlighting that no clear negative catalyst has emerged to break the broader AI narrative. Under the surface, capital is concentrating in a small group of core enablers while more speculative names lag. Investors see platforms like NVIDIA, Micron, Microsoft, and other key infrastructure players as less stretched than peripheral AI stories, where smaller semiconductor, optical, and niche hardware stocks are viewed as most vulnerable if positioning needs to be reduced. The next phase of the cycle is shifting into primary markets, and that is where the stress test begins. Roughly 4 out of 5 prospective listings are AI or AI adjacent, with names such as SpaceX, OpenAI, and Anthropic expected to tap public markets, plus a wider surge of tech issuance that could absorb a lot of equity capital in a short window. Because cash balances are limited, funding these deals likely means selling existing positions, particularly in mega-cap tech that is already off recent highs, as well as in high-beta AI peripheral plays. Valuation and earnings durability are now the key debates. On one side, strong incremental margins, rapid revenue growth at firms like Anthropic, and deals such as Broadcom's large AI platform financing support the case for long-run cash generation and significant infrastructure demand. On the other, OpenAI's high cash burn relative to revenue, questions around revenue sharing with partners, and governance complexity show that some flagship names still lack a clear path to matching today's lofty pricing. Beyond equity stories, the AI build-out is visibly macro-relevant. Trillions of dollars are being directed into data centers, chips, and connectivity, with private credit structures funding multi-billion-dollar chip purchases and municipalities boosting issuance for infrastructure, all of which adds to near-term demand and cost pressures in semiconductors, energy, and specialized labor. Recent inflation data already show AI-driven investment contributing to demand-side inflation, and central banks are watching upcoming CPI and PPI prints for signs that this effect is broadening. At the same time, political anxiety about AI and proposals for direct government stakes raise the risk of heavier regulation and greater concentration, which could eventually reshape who captures the economics of the theme. In summary, the AI trade has shifted from a simple beta story into a contest over liquidity, governance quality, and pricing power, with core infrastructure and upcoming IPOs at the center of the narrative. Geopolitics are still driving the risk backdrop, but markets are currently treating the energy shock as manageable. Brent has slipped back toward the low $90 area, and WTI has dropped below 90 as headlines around ceasefire talks between Israel and Iran and commitments to halt strikes encourage traders to fade the immediate war premium. That pullback has helped equities refocus on AI and growth, and has taken some pressure off bond markets that were reacting to earlier oil spikes. Beneath softer prices, however, the logistics picture remains fragile. Shipping through the Strait of Hormuz is still running far below pre-conflict levels. Many carriers continue to avoid the Red Sea and reroute around Africa, and tanker blockades plus security risks are drawing down inventories that have already fallen from roughly 8 months of cover to near 6. If that depletion trend persists, several analyses point to a window later in the summer when even modest new disruptions could push crude toward the $125 to $150 range. At the same time, strategic competition is spilling over into trade, technology, and defense spending. Taiwan is weighing tighter controls on advanced AI chip exports to China, aligning with U.S. efforts to limit leading-edge semiconductor flows, while the Pentagon's designation of some major Chinese firms as linked to military activity underscores the regulatory risks for cross-border tech business models. Defense and aerospace budgets are set to rise across the U.S. and NATO, even as projects like the German-French fighter jet program hit political delays, and that mix is drawing more private capital into dual-use and surveillance technologies, often with AI at the core. The counter-argument is that parts of the global system can buffer these shocks. China has already scaled back crude imports and refinery runs, taking some heat out of prices, and North American economies are less exposed to Hormuz, allowing central banks there to look through temporary spikes more easily. For now, markets are leaning toward that benign view, but the risk is that a slower reopening of key shipping lanes, renewed escalation around Lebanon or Iran, or tighter tech export controls could quickly shift the narrative back to shortages, higher freight costs, and renewed volatility. That would directly feed into the inflation and rate discussions, which are already front and center. The rate story has moved a long way from the cuts debate earlier this year toward a question of whether hikes are coming back onto the table. Short-dated yields have pushed above the effective Fed funds rate. Options on interest rate futures are pricing roughly equal odds of no change, or as much as 100 basis points of tightening, and several major institutions now expect multiple Fed hikes starting in December. Incoming inflation data are doing little to ease that pressure. Headline CPI is expected to print near 4.2% year-on-year, the strongest reading in around 3 years, and core PCE is projected to edge up toward 3.4%, both well above the Fed's target even after some recent easing in gasoline prices. On top of that, AI-related capital expenditure, resilient growth, and the possibility of another oil shock make it harder for policymakers to argue that inflation is on a secure path back to 2%. Policy paths are also diverging across regions. The ECB is widely expected to deliver another rate hike despite soft euro area data and constrained household demand, a combination that many see as increasing the risk of a policy mistake and eventual reversal. In emerging markets, central banks such as Indonesia have already executed off-cycle hikes to stabilize currencies and stem capital outflows, underlining that FX fragility is still a constraint on policy autonomy. Meanwhile, investors globally are rotating toward short maturity bonds, where yields around 5% offer attractive carry relative to stretched equity valuations. Against that, bond markets are signaling that long-term inflation expectations remain contained. Most of the repricing has occurred at the front end, while long-dated Treasury yields gravitate near 5%, levels that policymakers appear comfortable using as a tool to cool equity excess without signaling a loss of inflation control. The Fed's ability to accelerate quantitative tightening is limited by past episodes of funding stress, when reserves fell too fast, and credit availability for real economy projects, including AI infrastructure and housing, remains robust. That combination leaves the door open for a prolonged pause, even if the formal easing bias is withdrawn at the upcoming meeting under the new chair. For markets, the key question from here is whether incoming CPI, PPI, and central bank communication justify the current higher for longer pricing or force another round of repricing just as the AI IPO calendar hits. Bringing it all together, AI remains the primary growth and equity story, but the way it is funded is changing with a crowded IPO pipeline, large private credit deals, and tighter scrutiny on business models and regulation all influencing where capital can still earn a premium. Geopolitical risks around energy choke points and technology supply chains have faded a little in day-to-day pricing. Yet low inventories and unresolved negotiations mean the tale for oil, inflation, and volatility is still alive. And on top of that, the monetary cycle is shifting toward a higher for longer stance, with short-end yields doing most of the work while long-term expectations stay anchored, leaving asset valuations sensitive to every new data point. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.